Well, welcome back. Here's a look at where markets ended the week after the major banks kicked off second quarter earnings season. JP Chase, Wells Fargo, Citigroup, all reporting a double beating on earnings and revenue. For the quarterly numbers, the June producer price index came in hotter than expected year over year, up 2.6%, and month over month up 0.2%. This after the consumer price index came in cooler than expected annually at 3%. Meanwhile, Federal Reserve Chairman Jay Powell putting a pre-election rate cut on the table while testifying before Congress this week, pointing to a cooling labor market, but he says it's not political. Joining me now is Allianz Chief Economic Advisor and former CEO of PIMCO, Mohamed El-Erian. Mohamed, great to have you this week. Thanks very much for joining us. I want to get your assessment of the macro story. Take a look at the inflation numbers we did get this week. How do you view them, and how would you assess the macro growth story right now for the U.S. economy?
So the main message that has come out from the two inflation reports that you just mentioned is, first, demand is weakening. We're seeing demand destruction where people simply are not buying as much as they can buy. Companies are losing pricing power. And that speaks to a bigger phenomenon, which is that the U.S. economy is weakening at a faster pace than most people expect, including the Fed. The second element that came out is that the supply side is a problem, that while demand is weakening, the supply side continues to result in sticky PPI inflation. And it means that companies are going to face a squeeze on their margins and are going to have to make really difficult decisions as to how much they want to pass on the higher costs.
Well, that's really what I wanted to get into, because we are at the start of second quarter earnings season, Mohamed, and I'm wondering when these hotter readings are going to show up in margins for corporate America. What is your expectation for the second quarter earnings period, which just began on Friday?
So I would encourage everybody to listen very carefully to what companies are telling us. The reason why the Fed and others got the big inflation call wrong back in 2021, when they called inflation transitory, is they didn't listen enough to what the companies were telling them. And at that point, the companies were telling them costs are going up. We are facing strong demand. We have confidence to pass on these costs in terms of higher prices. And lo and behold, we got the higher prices, and the Fed had to recognize it wasn't transitory. Now we're going to hear something very different in the next couple of weeks. We're going to hear, I suspect, companies confirming that they are seeing softening demand, seeing consumers having been turned off by the level of prices, and they're going to express concern about their ability to pass on the higher costs because of less pricing power. That's what I expect we're going to hear, and it's going to come ahead of the macro data, which will start reflecting that weakness in the next few months.
Yeah, so how weak could this macro story get? Are you worried about the U.S. economy moving into recession next year?
So I put the risk of recession at 35%. The risk of a soft landing, meaning, yes, we slow a bit, but nothing dramatic, at 50%. And then the risk that we get a positive productivity shock from what's happening in life sciences, in generative AI, in sustainable energy at 15%. So depending on whether you're optimistic or pessimistic, you'll either think 50 plus 15 of a soft landing, something better, I like that, or you'll think 35% of a recession, that's really high for such an event. So recession is not my base case, but it assumes, importantly, that the Fed starts cutting rates. Because as you know, Maria, the impact of monetary policy comes with a lag. And if the Fed falls behind, then it will not deliver the soft landing. We've only had one soft landing in the last few decades, and that is 1995, when the Fed moved early and recognized that its policy acts with a lag. Unfortunately, right now, we have a Fed that's overly data dependent.
Mohamed, it's great to see you. Thanks very much for your insights on all of that.
Thanks for having me, Maria.
All right.